Hello everybody and welcome to The Bottom Line here on TVP World, where we unpack some of the main business and economic stories of the day. I'm your host, Don Arleth, in for Marie Cato. Today, over 24 world leaders are attending the Victory Day parade in Moscow to commemorate the Soviet Union's role in defeating the Nazis in World War II. This annual show of force has dwindled in recent years due to the heavy toll the war with Ukraine has taken on Russia's armed forces. Also under duress is the state of the Russian economy. To better understand the extent to which this is happening, let's now take a look at Jan Kennedy's report.
Thousands of Russian soldiers marched through the streets of Moscow to celebrate the 80th anniversary of Victory Day. At first glance, this display reflects Russia's might. However, a closer look at the economic situation suggests that the country may not be as strong as it seeks to portray itself.
You see the government spending and the defense sectors, security sectors, driving continued growth, but there's always going to be a limit to that. And now we're hitting those limits.
This comes as Russia maintains an eye-watering 21% interest rate, held steady by the central bank amid stubbornly high double-digit inflation.
To reduce inflation, we need to maintain tight monetary conditions for a long time, and our future decisions will depend on how quickly and steadily inflation slows down.
To make matters worse, due to war, the civilian economy is suffering a manpower shortage.
The labor shortage in the construction sector is in the top 3 of labor shortages in all sectors of economy. According to different estimates, it is about from 200,000 to 400,000 workers.
Adding to Russia's woes is the declining price of oil. This week, it dropped to a 2-year low and currently 40% below what the Kremlin assumed in its annual budget.
They're selling oil at a lower price and they're getting less proceeds in local currency in the domestic market. So that was bad for the corporations. That was bad for budget revenues. And that continues because the ruble is at a quite strong level.
This prompted Moscow to raise this year's budget deficit estimate to 1.7% of GDP, up from half a percentage point. And to address this shortfall, the government was forced to tap its fiscal reserves, withdrawing $5.5 billion. And in a couple of years, Russia's revenue from energy sales to the EU could drop to zero, as the EU calls on member states to completely sever their dependence on the Kremlin.
We ask member states to make mandatory national plans for phasing out Russian gas, nuclear fuel and oil. These plans need to be ready by the end of this year.
Fearful of being left without a major market for its biggest earner, Vladimir Putin is eager to deepen energy cooperation with China through the construction of an 1,800-kilometer-long gas pipeline called Power of Siberia 2, with a capacity of 56 billion cubic meters.
Finally, after begging and pleading, really since the full-scale invasion, they're starting to talk about Power of Siberia 2, so increasing Russia's gas exports to China. Now, this is something they wanted to start years ago, and China, frankly, wasn't interested enough. Now, they just literally, in this past week, have initiated conversations about this.
If successful, Power of Siberia 2 would increase Russia's gas exports to China to 98 billion cubic meters, only half the volume it exported to Europe in 2019. Even if both countries reached an agreement soon, the scale of the project means it would take years to complete and would fail to provide the Russian economy with much-needed instant relief.
Now, some experts have been sounding the alarm that Russia's wartime economy, external sanctions, and frozen assets have weighed down the economy so much that an economic collapse is imminent. Others say not so fast. The Russian economy is more resilient than one might think. Russia saw large economic growth from 2022 to 2024 and just now is starting to show a slowdown, coming in at just over 1.5% for 2025. Interest rates and inflation have also placed a big strain on Russian consumers and businesses. A slide in oil prices has put further pressure on Russia's budget. So what is the true state of affairs? To help us break it down, we are now joined by Sergey Vakulenko, Senior Fellow at Carnegie Russia Eurasia Center.
Good afternoon.
Good afternoon, Sergey. Thank you for joining us on The Bottom Line. Now, let's go ahead and start with recently Russia has been really trying to reduce this high inflation that we've been seeing by hiking interest rates. It's only natural. But is this working for the Russian economy?
Well, the slowdown we are observing now is at least partially the function of this hiking up of the interest rates. It's not a bug, it's a feature. The central bank was quite concerned that the economy was overheating, reaching its capacity, both in terms of labor and capital stock, and they just wanted to slow it down. And now they're saying that it's probably working, and if the economy slows down substantially, they might try to tune the interest rate down a little bit as well. And also the low oil prices might help the central bank in that sense as well. What's not helping is the quite high exchange rate of Russian ruble to US dollar, which is rather unnatural to all the economic environment and has been probably fueled by irrational exuberance a few months ago when there were hopes in Russia of a possible warm-up between Russia and President Trump, United States.
Right now, you've mentioned the oil prices. We've seen drastic declines in the global price of oil. We all know that the Russian oil is sold at a discount. How are we expecting this to affect the budget this year? It seems like it's far short of what Russia needs to break even.
The math is quite clear. Every $10 a barrel drop, if maintained on annual basis, deprives Russia of $25 billion of revenue and the budget of $20 billion of taxes. So there you go, can make your figures.
Okay.
Indeed, that's much less than what put in the budget numbers. The budget, when it was put together in September, October, had extremely ambitious oil price assumption of roughly $70 a barrel for a barrel of Urals, not Brent, Urals. You've mentioned there's a discount, so this would be commensurate with $80 Brent, which seemed quite high. However, looks like it was a trick. The finance ministry didn't want to fight with all the interest groups who were hoping to get themselves a piece of that budget. So they've put the budget together, picked a price that more or less balanced it, and had in mind whom they would cut when the budget wouldn't balance. And now it's exactly the time. And then they say, oh, we have urgently to make the budget balance. So sorry, folks, yours and yours project will have to shift right in our schedule. We'll have to freeze budget allocations for you for a year or two, and so on and so forth. Politically, it's much easier for them. So that's why I think they went into this game in the first place.
Okay, so basically their solution for the Russians is to just cut positions in the budget. Now, they also have this sovereign wealth fund in Russia that they draw upon. Where does that stand, and how much cushion does that provide the Kremlin?
Again, it's relatively low at the moment, but comes July, that fund will receive another 1.4 trillion rubles. At the current exchange rate, it's almost $20 billion. So it will be replenished. So it will be another couple years at least before that fund dwindles to zero at the current economic environment.
Now, since the full-scale invasion of Ukraine, this is something I mentioned in my introduction, many analysts have been saying that sanctions would cripple Russia, it wouldn't be able to sustain its war effort, its budget would collapse. Just how resilient, in your opinion, is the Russian economy, and why?
It was the assumption at the beginning of the war. I was definitely in the camp of not so fast, as you've mentioned earlier. And seems like Russia is getting, well, quite adjusted to the change in the economic situation. There were thoughts that Russia wouldn't be able to readjust itself to the new supply chains, that what would cripple Russia, not the sheer lack of money and funds, but inability to source parts and other elements for its economy. Well, Russian economy managed to do so. However, the trade surplus that Russia has been running and still is running is such that it definitely can sustain a military effort. And so far, the Russian state has been trying to run the economy in a way that population would be almost isolated from wartime hardship. There are still quite a few luxury items in what Russia is spending on, year out. So if you look, for example, at the balance of trade between Russia and China, main elements in there are tablet computers, mobile phones, cars. Well, definitely a country can easily do without, with previous year iPhones or Xiaomi phones and previous year's cars and so on, without much effect to the well-being of population. So that's definitely a reserve the state can fall on to keep its military spending. And the items I've just mentioned, they are roughly $60 billion.
So in comes China. I want to get to that in just a moment, but let's go ahead and stay on the trail of sanctions. Are the sanctions against Russia simply too weak? The Trump administration has recently floated the idea of 400% tariffs on any country who purchased oil from Russia. But that would also probably include sanctioning European countries as well. Is this a feasible proposal? And if there is any adjustment to the sanctions regime that would have a meaningful effect, what would those be?
Russian trade these days is mostly with India, Turkey, and China. It's quite difficult to have meaningful and impactful sanctions on somebody whom you're not trading with. The energy trade with European Union is 15 billion cubic meters of gas, so that's worth roughly $5 billion. Well, Europe definitely can cut that. This would be, well, material effect for Russia, but not drastic. Oil trade is much lower than that. Pipeline gas cannot be rerouted somewhere else, but LNG coming from Russia can indeed be sold elsewhere. So this would be a symbolic effect. This definitely would change the situation for European energy security, but wouldn't have a very strong economic impact on Russia. Russia is dependent both for supplies of the materials it needs and for hard currency on China, India, Turkey in the soda. Some of the hydrocarbons Russia sells to Turkey find their way to Europe as well, in various ways and ruses, but they do. But then it's a question how tough Europe wants to be on Turkey, for example. Whether Europe can do something with India, probably not. And these sanctions that Donald Trump and Senator Lindsey Graham are threatening on Russia, well, you might try to slap 500% secondary tariffs on everything China exports to the United States, but there is an ongoing tariff war between China and the United States, and the United States have already been going down in that war. So putting that additional secondary sanctions on Chinese exports to the US is probably counterproductive and not going to work.
Yeah, it seems like some of the leverage there has been lost. The United States also floated rapprochement with Russia and stronger economic ties to presumably drive a wedge between Russia and China. Yesterday, the two leaders signed an agreement to deepen ties, quote unquote. Neither country seems to be interested in destroying their relationship. Is such a maneuver even possible, or is it feasible to try and drive a wedge between China and Russia?
Well, it's been called reverse Nixon. So in 1972, President Nixon at Henry Kissinger's behest dealt with China, recognized China before that, and that was the idea to pull China away from the Soviet orbit. Well, currently the idea is, well, let's try to pull Russia away from China's orbit. Problem here is that there is much less than the US can offer to Russia to replace the beneficial relationship between China and Russia. There's not that much that US can offer economically to Russia, opposed to the depth and width and monetary value of the current trade between Russia and China. So this would be very, very difficult in my opinion.
And would you also say that China was the saving grace for Russia since the full-scale invasion? If it wasn't for China and those relations, perhaps we'd see Russia in a very different situation?
It's definitely so. China is the most important trade partner for Russia, both in terms of export revenues. Russia had to go through many difficulties by redirecting its maritime oil trade to China, but it succeeded. Russia has built a 38 billion cubic meters gas pipeline to China. The prices on that pipeline are actually quite lower than what Russia earned from its sales to Europe, but it's now a sizable source of gas revenue. And also China is an important source of technology goods for Russian economy, both to replace the civil goods that are unavailable from European or American suppliers for the Russian economy. That's what kept many parts of Russian economy going, but also dual use goods that make their way into drones and missiles and tanks and things like this.
So if we're looking for signs that the economy is crumbling, some red flags, what should we be on the lookout for?
It's not crumbling yet, and it's a long way before it will be crumbling. But you might be looking at the balance of foreign trade. So if oil prices would plummet further down, you would have to look at inflation, you would have to look at the exchange rate. But again, we are in a situation when Russian economy pretty much retooled itself to the military-style economy, and it has a whole arsenal of wartime measures that it hasn't employed yet. And I think what would happen, and this happened in the past, in 2008 and 2014, Russian government was quite effective communicating to the people that the hardship they are experiencing are not the fault of the government, but sorry folks, it's just the oil prices that were down. Tighten your belts. Oil prices were high, there was good times, and now it's out of control. And people were buying these stories. So even if oil prices go to like 40, 30, the government would still be able to maintain its reasonable approval ratings and and again, having enough resources by probably skimping on butter, but still keeping spending on guns, unfortunately, for at least a few years.
Okay, Sergey Vakulenko, Senior Fellow at the Carnegie Russia Eurasia Center. Thank you for that very honest assessment. It's very enlightening. We appreciate it. Thank you, sir.
Sorry for not the most encouraging news.
But thank you. And that concludes this edition of The Bottom Line. I'm your host, Don Arleth, in for Marie Cato. You can watch The Bottom Line every weekday at 5 CET on TVP World. For the latest regional business, follow us on X and tvpworld.com. And for more news and analysis, stay right here with us on TVP World. Thank you for watching, and see you soon. Bye-bye.